Hello, welcome to the Reed Smith webinar on Massachusetts net worth-based tax. Before we begin, we wanted to cover a few housekeeping items. At the bottom of your screen are multiple application widgets. You can find a copy of the program slides by clicking on the widget that looks like a folder. If you have any technical difficulties, there was also a help widget. A recording of today's webinar will be available in approximately 1 day and will be accessible using the same link that was sent to you earlier. For those of you who are unfamiliar with Reed Smith, we have the largest state tax group of any law firm. Our Massachusetts tax practice includes appeals before the Department of Revenue and the Appellate Tax Board on both sales tax and corporate excise tax issues. I am Mike Jacobs, a partner in Reed Smith State Tax Group. Before joining Reed Smith, I was a partner in a Boston law firm handling state tax issues. With me today are 3 other members of Reed Smith State Tax Group who specialize in Massachusetts tax issues: Rob Wayman, Brent Beisel, and Sebastian Watt. For today's webinar, we'll start with some basics on how the non-income-based portion of the Massachusetts corporate excise tax is computed. We'll then move on to discuss which types of corporations are subject to the non-income-based portion of the corporate excise tax and which are not, and discuss how the tax is computed in greater depth, highlighting some pitfalls and some refund opportunities. The webinar should run about 45 minutes. If you have any questions, please feel free to send them to us using the contact information on the last slide or the Q&A widget at the bottom of your screen. With that, let's begin the presentation. The Massachusetts corporate excise tax is typically thought of as an income-based tax. However, the tax also has a non-income-based component that we're going to refer to today as the net worth tax. This tax is not an alternative tax. All corporations, with some notable exceptions that we'll discuss later, are subject to both the income and non-income-based portions of the tax, or, if greater, a $456 minimum tax. The tax is imposed at a rate of 0.26% on one of 2 bases. The base that is used depends on whether or not the corporation is classified as a tangible property corporation. Tangible property corporations compute the tax based on the book value of tangible property located in Massachusetts on the last day of the taxable year. That's property that's not subject to local taxation. All other corporations subject to the tax compute the tax based on taxable net worth apportioned to Massachusetts. Regardless of which base is used to compute the tax, it is computed on a separate entity basis. Unitary combined reporting only applies to the income-based component of the corporate excise tax. A corporation is classified as a tangible property corporation if the book value of the corporation's tangible assets located in Massachusetts on the last day of the taxable year and not subject to local taxation is greater than or equal to 10% of the corporation's total assets on that day, less investments in 80% or greater owned subsidiaries, and less assets subject to local taxation in Massachusetts, with that difference multiplied by the corporation's income apportionment percentage. Because the tangible property classification is limited to corporations with a large portion of their assets held in the form of tangible assets in Massachusetts, most corporations are going to fall outside of that classification. For the remainder of today's webinar, we'll be focusing primarily on issues applicable to corporations that are not tangible property corporations. Although the net worth tax applies to most corporations that have nexus with Massachusetts, it specifically does not apply to financial institutions or insurance companies. What many taxpayers do not realize, though, is that Massachusetts' definition of a financial institution is broad enough to include many corporations that you might not otherwise think of as being a financial institution. First, in addition to including entities that you might normally think of as a financial institution, like a national bank, a savings and loan, or a bank holding company, the definition also includes any entity that derives more than 50% of its gross income from loan origination, lending activities, or credit card operations in substantial competition with banks. In the first Marblehead case, the Massachusetts Appellate Tax Board interpreted this language broadly to include a securitization entity that purchased certain loan portfolios. The board found that the entity was in substantial competition with banks, even though it didn't originate any loans, simply because it was in competition with banks that also purchased loan portfolios for securitization. Thus, if you have a securitization entity in your corporate structure, and that entity purchases loans, that entity may be classified as a financial institution and as a result should not be subject to the net worth-based tax. Second, it's important to remember that Massachusetts follows the federal treatment of single-member LLCs that are disregarded for federal income taxes for purposes of the net worth-based tax. This means that there is a position that if the financial institution classification of a disregarded member LLC will end up being attributed to its corporate member for purposes of the member's own classification determination. For example, we're aware of situations in audits in which the department has taken the position that a corporation that is engaged entirely in non-financial activities is nonetheless a financial institution based merely on the fact that the corporation owned a disregarded single-member LLC that was registered as a small loan business or retail installment sales company with the Massachusetts Division of Banks. It's important to remember that being classified as a financial institution is not always going to be beneficial for all corporations. For one thing, financial institutions are subject to the income-based portion of the tax at a higher rate than regular business corporations. And for another, financial institutions are not permitted to carry forward prior year losses. However, for some taxpayers, these negatives are going to be outweighed by the benefit of not being subject to the net worth-based tax. Thus, the disregarded treatment of a single-member LLC could provide a planning opportunity for a taxpayer that has a small loan company or a retail installment loan company registered with the Massachusetts Division of Banking somewhere in their corporate structure. Based on our experience, we have found this to be a common fact pattern for businesses in the telecommunications industry and also in the automotive industry. For such a business, eliminating liability for the net worth-based portion of the corporate excise tax could be as simple as converting the regulated loan or finance company into an LLC that's treated as disregarded for Massachusetts corporate excise tax purposes. As I mentioned earlier, corporations that are not tangible property corporations compute their tax based on net worth with certain limited deductions. Taxable net worth is computed by starting with the book value of the corporation's total assets on the last day of tax year and subtracting three items. 1, the corporation's liabilities on the last day of the tax year. 2, the corporation's investment in 80% or greater owned subsidiaries. And 3, the corporation's assets subject to local taxation in Massachusetts. Then the remainder is multiplied by the corporation's income apportionment factor. The book value of a corporation's assets for purposes of computing the tax is not necessarily tied to the total value of the corporation's assets as reported for financial accounting purposes. This is because book value is defined as the original cost for an asset less any depreciation or amortization deductions allowed for financial accounting purposes. This definition does not include the value of fictional assets that are placed on the books of a corporation which have no original cost. For example, when a corporation purchases a subsidiary for a price in excess of the book value of the subsidiary's assets, any excess is generally pushed down to the subsidiary's balance sheet as a purchase accounting adjustment for GAAP purposes. These adjustments are necessary in the context of preparing a consolidated balance sheet to prevent the understatement of consolidated net worth. However, for purposes of the net worth-based tax, which is computed on a separate company basis, we would argue that these fictional assets should be ignored for two reasons. First, because they're merely an accounting fiction that have no relevance in computing a corporation's separate company balance sheet. And second, because these adjustments have no original cost. Removing these purchase accounting adjustments from taxable net worth has the potential to be a significant refund opportunity for any corporation that was recently acquired by another corporation for a price in excess of the total book value of its real assets. Now I'm going to turn things over to Brent, who's going to discuss how liabilities are included in the net worth calculation and which obligations count as true debt.
Thanks, Mike. Now we'll turn to the department challenges to deductions from the net worth tax base, beginning by examining which liabilities are deductible. The net worth computation starts with simple balance sheet accounting. A corporation's taxable net worth is equal to its assets minus its liabilities. But this simple computation has been one of the biggest sources of controversy at audit and on appeal because the department has been aggressive in challenging taxpayers' treatment of intercompany obligations as a liability. This comes as a surprise to many taxpayers. After Massachusetts adopted an aggressive add-back regime in 2002 and mandatory combined reporting in 2009, one could reasonably think that audit scrutiny of intercompany debt would go away. But if anything, audit scrutiny has increased. On the income-based component of the tax, adjustments to intercompany debt still come up, particularly if the lending affiliate is a foreign entity outside the combined group. And on the net worth-based component, this issue continues to affect taxpayers because the department recharacterizes debt liabilities as equity. Here's a typical fact pattern. Consider a corporation that is taxable in Massachusetts. The corporation borrows money from a foreign affiliate for use in its business operations. In exchange, the corporation issues a promissory note to the foreign affiliate and, as a result, characterizes the obligation as a liability, a note payable to the foreign affiliate. However, the department disallows the corporation's treatment as a liability and instead will reclassify the intercompany obligation as equity. In other words, the department views the borrowed money as disguised capital that the foreign affiliate pumped into the corporation to fund business operations. Now, what does the effect of this reclassification mean on taxable net worth? Well, remember our basic balance sheet rule. Assets minus liabilities equals net worth. Now that the department has recharacterized the debt as equity, the deduction for liabilities is smaller and the net worth is larger. While many states challenge intercompany debt, our experience is that Massachusetts is more aggressive than almost any other jurisdiction. And Massachusetts courts have applied a true debt analysis that places a higher burden on taxpayers than any other jurisdiction. But taxpayers do have defenses. First, there's a statutory position that net worth is defined under Chapter 63, Section 30 by its computation. And as Mike said earlier, the net worth computation begins with the book value of the assets less liabilities. So if the computation of net worth is by reference to the treatment of items for book purposes, then classifying an intercompany obligation as debt for book purposes should also be controlling. This argument has been made by several taxpayers on appeal in recent years, and while we think this is still the right statutory interpretation, recent cases such as the Staples and Mass Mutual cases have shown that tribunals have not been receptive to the argument. Thus, taxpayers are forced to apply the unusually harsh true debt analysis developed by Massachusetts. To show that the intercompany obligation is true debt, a corporation needs to show that the debt has a valid business purpose and economic substance. Massachusetts adopted federal principles to determine whether an intercompany obligation is true debt, beginning with the Appellate Tax Board's decision in the New York Times sales case. Since New York Times sales was decided in 1995, the Appellate Tax Board and Massachusetts courts have repeatedly analyzed and scrutinized the taxpayer's facts by reference to this list of factors. Now, following New York Times sales, the Appellate Tax Board decided a case involving true debt called overnight transportation. In addition to this list of factors from New York Times sales, the overnight decision added some additional true debt factors from federal law. However, almost all subsequent decisions have applied the more limited list found in New York Times sales. This slide highlights these factors that are specifically referenced in most of the Massachusetts decisions. One factor from the case law that we want to spend some time on is whether or not there has been consistent repayment of the principal debt. The chart on this slide shows that in 5 prior decisions we listed, there was no consistent repayment of the debt, and in each case, the taxpayer lost. Now, consistent principal repayment may not be enough to overcome the high bar to proving a debt is true debt, but it helps. In our experience, the repayment doesn't necessarily need to happen on a regular schedule to create true debt. We have handled cases involving the true debt issue where the taxpayer can show that repayment occurred, even if it occurred years after the loan was originated and didn't follow the scheduled payment terms of the debt, or the debt instrument allowed for a gap period where no scheduled payments were due. In some cases, the loan was incurred during a period under audit, and the repayment occurred years later outside the audit period. If the corporation can show that the repayment occurred, in our view, it can strengthen a case and allow taxpayers to differentiate themselves from existing case law. It still won't be enough on its own, but there are no published decisions where a taxpayer won on the true debt issue without showing repayment. While most published cases cite to a consistent list of true debt factors based on the list in New York Times sales, there are additional factors to consider. Department audit narratives often reference other factors including the risk involved, the debt-to-equity ratio of the debtor, the ability to obtain third-party loans, and whether the loans are secured. I introduced the idea of this expanded list of factors a few minutes ago. These additional factors were adopted and applied by the Appellate Tax Board in the overnight case. Since overnight, the broader list had often been overlooked in favor of the more limited list from New York Times sales. However, recently, the Appellate Tax Board applied and analyzed this broader list of factors in Mass Mutual, a case published in 2015. Using the broader list of factors from overnight, Mass Mutual prevailed in arguing that its debt was true debt, and is a rare instance of a recent case in which a taxpayer was able to win on the true debt issue. So I've talked a lot about ways to ensure that an intercompany obligation is treated as true debt, but we should also consider the flip side. If the department has made an adjustment to reclassify an intercompany debtor's liability as an equity interest, then the affiliated lender may have a refund opportunity. The net worth measure of the tax has a deduction for investments in subsidiaries, so lenders should consider whether it can exclude the reclassified equity as an investment in subsidiary. I'll note that in many cases for our clients, this doesn't work because the lending affiliate has no nexus, but sometimes it does, and this adjustment should clearly apply if it does. One final point I'll mention is that there may be an opportunity to argue that debt going both ways between the debtor and lender should be netted as a way to mitigate the impact of a true debt adjustment. Now I'll turn it over to Sebastian, who will talk more about excluding investments in subsidiaries.
Thanks, Brent. We're going to talk about deducting the value of subsidiary corporations from the value of net worth. As Mike discussed, the net worth component of the corporate excise tax is based on the book value of a corporation's assets on the last day of the taxable year, and it's imposed on a separate entity basis. Here's the rule we're discussing. Net worth is reduced by the book value of 80% or greater owned subsidiaries. The analysis might be straightforward when the taxpayer owns a subsidiary directly, but questions arise when the taxpayer owns 80% if it could look through chains of corporations and partnerships. We're going to use 4 examples based on common situations we see our clients facing. We'll start with a basic example to explain the purpose of the deduction, then we'll discuss why we think the purpose of the deduction means taxpayers can apply it more broadly. The purpose of the deduction is to prevent double taxation. Without the deduction for 80% owned subsidiaries, the net worth of the assets held by subsidiary corporations would be taxed twice, once by the net worth imposed on the subsidiary itself, and a second time by the net worth imposed on the parent. Take the following example. Parent corporation, P, owns 100% of subsidiary corporation, S, that together file a combined Massachusetts return. Let's assume all entities are examples have 100% Massachusetts apportionment. P owns assets worth $500, and S owns assets worth $500. So all the assets owned by the PS group are worth $1,000. This slide shows the net worth tax impact without the deduction for 80% owned subsidiaries. Here, P pays net worth on the book value of its $500 worth of assets, but P's investment in S, worth $500, is on P's balance sheet, so it's included in its net worth tax base as well. S also includes $500 of assets in its tax base because the tax is imposed on a separate entity basis. Without the deduction for 80% owned subsidiaries, the PS group would pay net worth tax on $1,500 of value, even though it only owns $1,000 of assets. But as you can see on this slide, if we apply the deduction for 80% owned subsidiaries, the PS group pays net worth based on the true value of its assets. The double taxation is eliminated. This concept of preventing double taxation is a theme in Massachusetts tax, and net worth tax in particular. The Supreme Judicial Court has been clear that tax laws are to be interpreted so as not to cause double taxation unless no other reasonable construction is practicable. And the Court has applied that principle in the net worth context. For example, in the New England Mutual case, the Supreme Judicial Court considered whether property leased from a third party and used in a taxpayer's business was subject to Boston's local property tax. The Court acknowledged that a plain reading of the statute would result in the property being included in the property tax base. However, the Court decided to read the statute in its larger context and purpose to conclude that the plain reading should give way to prevent double taxation. The Court reasoned that the legislature did not intend leased property to be included in the taxpayer's property tax base because it was included in the lessor's net worth tax base. The Court did not apply a plain reading of the statute because that would result in double taxation, a result that was not intended by the legislature. With the purpose of the deduction in mind, let's move to our second example. This example is pretty simple. We're just going to put a partnership in between P and S. So now P owns 92% of an LLC classified as a partnership for federal tax purposes, and LLC owns S. This structure should not change the result. Because P owns more than 80% of S, the statute should allow the deduction. That's the right result because it prevents double taxation. The Department addressed this fact pattern in a 2017 letter ruling. Notwithstanding the statute and the Supreme Judicial Court's reading of net worth statutes to prevent double taxation, the Department took the view that P could not deduct the value of S from its net worth. The Department justified its decision by applying the entity theory of partnerships, which generally views a partnership as a separate entity. The Department explicitly rejected the aggregate theory of partnerships, which treats the partner as directly owning a proportionate share of its partnership's assets. So here, applying the partnership aggregate theory would treat P as owning 92% of S directly. The Department reasoned that while the aggregate theory has a place in income tax, it has no necessary application in the context of a net worth tax. The problem is that the ruling provides no support for why the aggregate approach doesn't have a necessary application for the net worth tax. The Department simply refers to the rule that deductions are strictly construed against taxpayers. So the Department's rule seems to be that in the context of a deduction, the test to figure out whether you apply the entity or aggregate theory is apply the result that's worse for the taxpayer, just because deductions are generally strictly construed against taxpayers. We don't think that reasoning is supported by the law. First, there's a clear preference in cases before the appellate tax board in applying the aggregate over the entity theory. Second, and more importantly, the rule for applying the entity or the aggregate theory is that you look to the purpose of the underlying purpose of the statute. In the letter ruling itself, the Department cites an IRS revenue ruling addressing the application of the aggregate versus entity theory. The ruling starts with a general proposition that both the aggregate and entity theory can apply to a tax statute. Then, the ruling states this rule. To figure out whether the aggregate theory applies, you look to the underlying purpose of the statute. So applying the revenue ruling cited by the Department in its letter ruling to this example, we ask, does P getting the deduction further the purpose of the underlying statute? Well, the purpose of the 80% owned subsidiary deduction is to prevent double taxation. And applying the entity theory is inconsistent with that purpose because it results in double taxation. On the other hand, applying the aggregate theory is consistent with the purpose of the 80% owned subsidiary deduction because it prevents double taxation. Therefore, the aggregate theory applies. Again, this is consistent with the Supreme Judicial Court's view that the net worth tax should be read to prevent double taxation. In this example, a court doesn't need to work very hard to get to that result because it's also consistent with the plain reading of the statute. The court doesn't have to go as far as it did in the MassMutual case to apply the principle over a plain reading of the statute. And that's not the only support for applying the aggregate approach to treat P as if it owned 92% of S directly. The department itself has historically applied the aggregate view and look-through partnerships in the net worth context. First, the department's nexus regulations treat a foreign corporation as doing business in Massachusetts if the corporation is a partner in a partnership that does business in the Commonwealth. That's a clear application of the aggregate approach. Second, for apportionment purposes, a partner includes its pro rata share of the partnership's apportionment factors in its own factors. Again, a clear application of the aggregate approach to net worth. To defend its position in the letter ruling in an appeal, the department would need to convince the appellate tax board and a court that the statute should be read in a manner inconsistent with this legislative purpose and explain why its position is inconsistent with other areas of net worth. Let's take another common situation we see our clients facing. In this example, the question is whether P can deduct its direct 60% interest in S2. P owns 60% directly and 40% indirectly through its interest in S1. We think it's pretty clear that P can take the deduction in this instance. First, as with the partnership example, we think the ownership requirement in the statute would be read consistent with its purpose to prevent double taxation. Second, the department's tax return instructions state that ownership for the purposes of the deduction is determined in accordance with Internal Revenue Code section 1504. 1504 is the section that defines an affiliated group eligible to file a federal consolidated return. Because P and S1 are members of affiliated group under 1504, P should arguably be able to deduct the value of S2 under the department's own guidance. Similar reasoning would arguably allow S1 to deduct the value of its investment in S2. Now let's combine examples 2 and 3. Let's assume that P and S1 own S2 through a partnership. This situation is a bit tricky because we have to look through the partnership to S2 and we have to apply ownership attribution rules. The added difficulty here is interpreting the department's tax return instructions that indicate 1504 applies. On one hand, S2 is not in an affiliated group with P and S1 under 1504 because of an intervening partnership. So the department could point to its tax return instructions and say the deduction is not allowed because the intervening partnership prevents P, S1, and S2 from filing a federal consolidated return. On the other hand, the P-S1 group together own 100% of LLC, and LLC owns 100% of S2 by looking through LLC. Applying a plain reading of the statute and interpreting the ownership requirement consistent with its purpose to prevent double taxation would also allow the deduction here. Moreover, even though the department refers to 1504 in its tax return instructions, applying 1504 by its terms isn't required by statute or regulation. There's absolutely no reason that the deduction should not apply simply because the federal government doesn't allow the P-S1 federal consolidated group to include S2. If 1504 applies in the previous example, which the department's guidance suggests it does, there's no distinction based on statutory interpretation or the purpose of the statute that the deduction shouldn't also apply here. Now I'm going to turn it over to Rob.
Thanks, Sebastian. As Mike mentioned earlier, the non-income measure of the corporate excise tax actually consists of two different tax bases, one imposed on net worth and one imposed on tangible property. But one common feature of the two tax bases is that property that is subject to local taxation is excluded from the tax base. For companies with significant amounts of tangible property, determining the amount of that property excluded from the tax can be trickier than one might assume. Specifically, disputes often arise if a locality could have imposed tax on tangible property under its local ordinances but did not. Consider the following example in a case brought by Reed Smith. In that case, a taxpayer had tangible property located in Massachusetts that was clearly subject to local taxation. However, several localities had failed to impose tax either due to an administrative oversight or because the property was not taxed for a period of years as part of a global settlement resolving other matters. The department argued that the failure to actually pay local tax meant that the property must be included in the tax base of the non-income measure of the corporate excise. Similarly, department auditors have assessed taxpayers that excluded the value of property that a local authority did not tax as part of a tax increment financing agreement. Again, on the basis that the property was not actually taxed locally and thus must be subject to the non-income measure of the corporate excise tax. Our view is that it does not matter whether tangible property is actually taxed. The statute only requires that the property be subject to tax. The decision by a locality to not require tax payment, either through administrative oversight, a TIF agreement, or settlement does not matter. Case law supports this conclusion. In Springfield Sugar and Products Company versus State Tax Commission, a taxpayer mistakenly paid property tax on property that was not actually subject to local tax. The taxpayer later discovered the issue and would have been entitled to a refund, but had missed the statute of limitations for claiming that refund. For corporate excise tax purposes, the taxpayer argued that the actual payment of the tax should control whether property is deductible from the non-income measure of the tax. The Commonwealth disagreed, arguing that the only consideration was whether the property was subject to tax. And the Commonwealth prevailed. It did not matter that the tax was actually paid. Our view is that taxpayers that do not pay local tax but were subject to the tax on tangible property are entitled to the same treatment. Now let's move on to apportionment issues. When reviewing taxpayer returns for potential refunds, we find that recomputing apportionment factors for the net worth measure of the non-income tax is a consistent area of opportunity. In our experience, these opportunities are often due to the differing nature of the net worth apportionment computation and the income-based apportionment computation. Specifically, apportionment factors for the income-based tax are computed on a combined basis. As a result, intercompany revenues are eliminated. Conversely, the non-income measure of the tax is computed on a separate company basis. For the separate company apportionment computation, intercompany receipts are included. Many taxpayers can exploit these differences to reduce their tax. Some common examples of issues that we have seen include intercompany management fees. Many intercompany management fees are classified as professional services under Massachusetts market-based sourcing rules. When the affiliates receiving the management services are headquartered outside of Massachusetts, taxpayers often have the opportunity to source these receipts exclusively outside of Massachusetts. Another common area of review is reversing the impact of combined reporting regulations. Massachusetts combined reporting regulations make several adjustments to a taxpayer's separate company apportionment. But those rules should not apply in the separate company context. For example, consider a company with a classic manufacturing, sales, and distribution entity structure. The manufacturing entity produces products that are sold to an affiliate that sells and distributes the product. For income tax purposes, the receipts from the manufacturing entity are eliminated. However, in many cases, the combined reporting regulations require the sales and distribution company to file as a manufacturer, which is subject to single sales factor apportionment rather than double-weighted sales factor apportionment. For purposes of separate company apportionment for net worth, this regulation should not apply, and the sales company can file using double-weighted sales. The same reasoning applies to any apportionment requirements implemented under the combined reporting regulations. A third issue we see involves intercompany receipts sourced to one or a few affiliate locations when the benefit of that service is delivered in numerous locations. Massachusetts rules for sourcing services, intangibles, and even tangible personal property often permit taxpayers to look through the location of the affiliated customer to the location of the ultimate customer using the service, intangible, or receiving the tangible personal property. For example, an entity that provides customer-facing software services to an affiliate can, in some cases, source those receipts to the location of the customers ultimately using the software rather than the affiliate purchasing the services. Finally, we have found that many taxpayers can benefit from closely examining the potential impact of Massachusetts insignificant factor apportionment rules. When Massachusetts business corporations have three-factor apportionment using double-weighted sales, Massachusetts will exclude a factor or factors if that factor is deemed immaterial. For net worth purposes, there are legal arguments for both applying these rules and excluding a factor, or for ignoring the rules, even for otherwise immaterial factors. Taxpayers have the opportunity to apply either option. And that concludes our presentation. Thank you to everyone for listening in today. We hope you enjoyed the webinar. If you have any questions, feel free to reach out to any of the presenters today or any other member of the Reed Smith State Tax Team. We're always happy to chat. Thank you again for listening. Enjoy the rest of your day.